Welcome to Weekly Review of the U.S. Economy. I am Glenn Ford Robinson. U.S. economy looks to continue good performance into 2020, but 2021 could be another story. These stories and more after the break. The U.S. economy looks to continue its good performance well into 2020. However, 2021 could be catastrophic. If the U.S. economy continues to expand too fast, with the stock market hitting new highs, the Federal Reserve will put the brakes on by raising interest rates, especially if inflation rates rise too high above 2% for an extended period of time in 2021. Inflation rate currently sits at 2.1%, so we shouldn't worry about inflation rates right now. But come 2021, things could be a lot different. We should expect some degree of decline in 2021, especially if 2020 sees rapid growth, simply because the economy goes through boom and bust cycles. So 2021 could be the year of the bust phase of the business cycle, because 2020 showed us the boom phase of the cycle. Such analogy makes perfect sense given the fact that at some point investors will begin to take profits from the financial markets. For example, equity investors will begin to take profit from the stock market, and currency investors will begin to take profit from the forex market. The rise in interest rates will be the catalyst that sets off an episode of profit-taking in the financial markets. The extension of the profit-taking frenzy will determine whether or not the economy continues into a recession. Again, recession happens to be a normal part of the economic cycle. Smart money or gurus of financial markets find such information as no secret. Guess who happens to be the ones who make money when the stock market crashes? By the way, does anyone make money when the stock market crashes? I will leave that answer up to you to ponder. You must know this answer to be a successful investor or trader. Successful investors or smart money also recognizes when to take advantage of opportunities that exist in the markets. This past week, the stock market presented such an opportunity. However, the visibility of this opportunity only presented itself to those who possess the ability to see it. Those investors wearing reflexivity lenses happened to be the first to see the opportunities presented in the equities market this past week. Reflexivity in economics refers to the self-reinforcing effect of market sentiment, whereby rising prices attract buyers whose actions drive prices even higher still, until the process becomes unsustainable and the same reflexive process reverses itself, leading to a catastrophic, rapidly sharp collapse in prices, often called a market correction, a pullback, or an all-out crash. The sharp and rapid decline in the prices often follow a negative catalytic event. This negative event could be presented from any of a multitude of areas, from geopolitical to monetary policy changes, For example, the continued lowering of interest rates meant by a sudden increase of interest rates could cause an economic shock. Such shock would immediately be manifested in rapid stock market decline, as consumers now have a harder time getting approved for bank loans. Less credit cards in the hands of consumers means less shopping by consumers. Retail sales would begin to suffer. Non-farm payrolls and unemployment would follow. Weekly jobs claim report would be the first to show signs of a decline in economic activity, followed by housing starts, housing permits, durable goods orders, and manufacturing. This past week's performance of the S&P 500, despite impeachment of the U.S. President by the House of Representatives, could be perceived as troubling, simply because impeachment of the President should be considered a negative event, which should have negatively impacted the stock market. But no, it instead boosted the stock market to yearly highs. Wait a minute. What exactly is going on here? This situation just handed us a plate of irrationality. Are you ready to partake in this delicious course of misconception? Market participants' irrational behaviors stems directly from the prevailing misconception. So, what is the misconception? The current misconception says that everything from a U.S. political standpoint is going well and is okay. But we can clearly see that everything is not okay. Our president has just gotten impeached, for Christ's sakes. How is that okay? Stock market participants, however, don't seem to think that there is a problem. So, they push the stock market to record highs despite hearing news of the impeachment. The pressing issue here is the prevailing misconception. A market trading higher solely on misconception-induced thinking is not sustainable, because sooner or later reality will set in, which will debunk the misconception, causing a market correction and causing irrational behaviors to cease, which will lead to the realization that mistakes in thinking were made. And now come the time to correct such erroneous thinking, and rational behaviors will once again dominate the direction of market sentiment, but not without widespread anguish. This new rational awareness will now cause the stock market to correct itself. A stock market correction will be intensified by self-reinforcement or the reflective process itself, which could cause catastrophic stock market declines. The magnitude of the decline varies depending on the underlying causes. In our current economy, there is no underlying factor that currently exists that could cause an all-out stock market crash. However, the stage is set for large market corrections or pullbacks to occur. Fallibility should always be taken into account when deciding how to invest. Never assume that what you are currently seeing is what's really there. Simply because we human beings are prone to making errors, and we are the ones participating in financial markets. So, financial markets are also prone to errors, causing the formation of misconceptions and irrational behaviors by participants. A massive stock market correction could very well occur in 2021. So, investors could be following the current sentiment by continuing to push the stock market to new highs throughout 2020. But come 2021, the tide could turn dramatically as investors take profit, sending the market to gut-wrenching lows. A measuring and calibration system that I use to measure and calibrate my own exuberance is called the happy-sad system. Simply put, the system kicks in when I am extremely happy and when I am extremely sad. When the system measures my exuberance level and sees that I have exceeded my normal happy threshold, it calibrates my mood, bringing it back to a sad state or mood even though the stimuli causing the happy state is still present. On the other hand, when the system senses that I am sad from a negatively perceived stimuli in my environment, it quickly reverts my sad state to a happy state, even though the negative stimuli that have caused my sad state in the first place is still present in my environment. This is the technique used by smart money. Okay. I am giving this to you for free because you have showed interest in reading my articles or watching my videos. So, you deserve this reward. Thanks for consuming my content. It makes me feel good that someone is actually learning from what I am teaching. I wish someone had taught me this when I was a toddler. Remember, what makes you mad initially will eventually bring you happiness and a lot of financial rewards if you just hang in there and get past that negative stimuli that caused you to be mad in the first place. It is called keeping your cool. Okay, enough with my philosophical rhetoric. Let us now put on our macroeconomic lenses and analyze what the economy is telling us from the macroeconomic level. The building permit report released on Tuesday, December 17, 2019 at 8:30 a.m. New York time beats market expectations of 1.410 million by posting an amazing 1.482 million, beating the previous mark of 1.461 million. Building permit report measures changes in the total number of new buildings permits issued by the government. The building permit report provides key information as to the demand in the housing market. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar. The November building permits report therefore shows that the U.S. economy has done extremely well, meaning that the economy continues to expand nicely. People now have money to buy new homes and are currently requesting more new homes, thus motivating developers to fill this demand by first applying for building permits from the government. The U.S. Census Bureau released the building permits report. The housing starts report for November also came in above market expectations of 1.345 million by posting a reading of 1.365 million, beating a previous reading of 1.323 million. The housing starts report measures changes in the annualized number of new residential buildings that began construction during the reported month of November. The report functions as a leading indicator of strength in the housing sector. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. The positive housing starts number confirmed that all those building permits have indeed manifested into new construction that are underway, further confirming that the U.S. economy continues to show positive growth. The U.S. Census Bureau released the housing starts report on Tuesday, December 17, 2019 at 8:30 a.m. New York time. The housing market has definitely benefited from the numerous interest rate cuts that the Federal Reserve performed in the past few months. The National Association of Home Builders NAHB Housing Market Index HMI evaluates the relative level of current and future single-family home sales. The data came about from the compiled survey of about 900 home builders. A reading about 50 indicates a favorable outlook on home sales, while a reading lower than 50 indicates a negative outlook. The current reading of 76 posted for December beats market expectation of 70 and a previous reading of 71. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. The Jones job opening report for October came in above market expectation of 7.018 million by posting a reading of 0.267 million, beating out a previous reading of 7.032 million. The Bureau of Labor Statistics used the JOLTS job opening survey to help measure job vacancies. The survey collects data from employers about their businesses, employment, job openings, recruitment, hires, and separations. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. The Bureau of Labor Statistics released the JOLTS Jobs Opening Survey on Tuesday, December 17, 2019 at 10 a.m. New York time. The Manufacturing Purchasing Managers Index, PMI, for December barely missed forecast of 52.6 and a previous reading of 52.6 by posting a reading of 52.5. This reading shows a positive sign, considering that the manufacturing sector have underperformed in previous quarters, and a reading above 50 indicates economic growth. The manufacturing PMI measures the activity level of company purchasing managers in the manufacturing sector. These purchasing managers perform the ordering of raw material for their manufacturing companies. So, these managers know more than anyone else about the health of their companies. As a result of their knowledge of the intricacies of their companies, traders pay close attention to the PMI report. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. A reading above 50 indicates economic expansion, while a reading below 50 indicates economic contraction. Market released the manufacturing PMI on Monday, December 16, 2019 at 9:45 a.m. New York time. The U.S. economy continues steady annualized growth in third quarter, matching 2.1% forecast and outpacing a 2% mark recorded 3 quarters ago. The gross domestic product, GDP, measures annualized changes in the inflation-adjusted total value of all goods and services produced by the U.S. economy. It functions as the primary indicator of overall economic health and acts as the overall measure of economic activity. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. The Bureau of Economic Analysis released the GDP report on Friday, December 20th, 2019 at 8:30 a.m. New York time. The third quarter increase in real GDP reflected positive contributions from personal consumption expenditures, PCE, federal government spending, residential investment, exports, plus state and local government spending that were partly offset by negative contributions from non-residential fixed investment and private inventory investment, a subtraction from overall GDP value. Wall Street rose to new highs on Friday as market participants looked past impeachment news. Aside from impeaching the president, the House of Representatives approved the U.S.-Mexico-Canada Agreement, USMCA, on trade. The new agreement replacing NAFTA will help to revitalize the U.S. manufacturing sector that has suffered severely from trade fights. The Dow Jones gained 78 points, or 0.3%, to 28,455 points. The S&P 500 added 16 points, or 0.5%, to 3,221 points. The Nasdaq climbed 38 points, or 0.4%, to 8,925 points. Please like, subscribe, and check the bell so you'll know when new weekly videos are uploaded. Stardom Finance commercial break. Are you a successful forex trader or a successful stock trader? and want to gain even more success as a trader? Well, look no further than the Amsterdam Finance Weekly Review of the U.S. economy. The weekly review comes in a video format and an article format. The video format, hosted by Glenn Robinson, can be seen on the Amsterdam Finance YouTube channel, and the article format can be seen on the Amsterdam Finance website at amsterdam.com for in-depth fundamental analysis of how to create a forex and a stock trading strategy using the data presented in our videos and articles. Please contact 631-747-7237. Disclosure. The Amsterdam Finance trading team currently trades the Euro-USD currency pair, utilizing long, short, and hedging strategies. Disclaimer. Information in this video and in our articles published on amsterdam.com may contain forward-looking statements, which could involve high risk and uncertainties. Markets and instruments profiled in our videos and in our published articles are for informational purposes only and should never be taken as professional investment advice or recommendations to buy or sell in these assets. You should do your own in-depth research before making any investment decisions. Amsterdam Finance does not guarantee that the information presented in our videos and articles is free from mistakes, errors, or material misstatements. It also does not guarantee that this information is timely in nature. Investing in open markets involves a high degree of risk, including the loss of all or a portion of your investment, as well as emotional distress. All risk, losses, and costs associated with investing, including total loss of principal, are your responsibility. I am Glenn Robinson. I will be back next week with another edition of Weekly Review of the U.S. Economy.